Thank you so much, Jeff, for joining us on a podcast at Dawdle.live. Extremely grateful that you took out time to share insights with our global audience. Thank you so much, Jeff, for joining us. We have got
Yeah, thank you.
very interesting set of topics for you on which we want to take your insights.
So my journey, my background, educational background is actually computer science and mathematical linguistics. But I started down a corporate path. When I finished computer science, I worked for NCR Systems Engineering in Europe for 5 years. And then I worked for Apple for 5 years. In Apple, I kind of got the startup bug because I was working with third-party companies who were building different stuff for the Apple ecosystem. So a couple of years later, I co-founded a company called TouchWave. This was in Denmark. I lived in Denmark for many years. And then we moved the company to Palo Alto in Silicon Valley.
Yeah.
That company was acquired by the Swedish telecom giant Ericsson. And then after that, I joined a company called Domo, also as a co-founder, because we were restarting the company, basically. That was acquired later by Avaya, also a big telecoms company. And then most recently, I built a professional services company called Base Miami after I moved to the East Coast. And Miami was acquired by the Mana Group, which is they're urban developers, and they're building an international tech hub right in downtown Miami. So since about 2010, I have been primarily working as an advisor and consultant to companies mostly from abroad who wanted to come to the U.S. because that was my direct experience, but also fundraising because between TouchWave and Domo, I raised just under $50 million. I had more experience than I ever wanted raising money.
Jeff, you have been on all sides of the table. You have been a founder, you have been a CEO, you have been a venture partner, and now a mentor and advisor as well.
Yeah.
What are the most profound operating lessons from your early startup years that have shaped your approach to mentoring founders today?
Yeah. So let me start with resilience, because that is an absolute necessity. In fact, there was very recently Jensen Huang from NVIDIA was speaking at Stanford Business School. It was a lecture on entrepreneurship, and the students asked about qualities for success. And Jensen said, you guys have not cleaned enough toilets. And I think that was his way of talking about resiliency, because you really get to clean a lot of toilets. Most of them are invisible when you start, and then they just start popping up as you go. So that's definitely one thing. Fundraising is something most people don't like, but you need to get good at, because in fact, one of my friends from Silicon Valley, multi-time CEO, multi-time acquisitions, he talks about the full-time job of the CEO in an early stage company is really fundraising, right? Because you're raising, typically it's an 18-month runway, and you're maybe 12 months in before you need to be actively fundraising again. And if you're on the careful side, you're going to start already at maybe 9 months in, right? So and even before that, you're trying to build the metrics that will help you get your next round and a higher valuation, right? So full-time job of the CEO. Timing is really important, and especially in fundraising. I remember one of my board members telling me, you don't want to leave the grapes rotting on the vine. That's one side of the timing. You need to strike while the iron is hot. But the other really important part of timing is having more than one venture deal that can close when you're trying to finalize a round. And if you're talking to one firm, but you're at the very early stage of that, and you're talking to another firm where you're very close to close, that's not going to work for you. All right. So if you want to awaken animal spirits and you want to drive the valuation, it's really important to have the timing right. I worked with a company called Asetek out of Denmark in the US around 2010, and we had the timing right when we were doing that fundraising project, and they ended up getting twice the valuation from one of the firms that the other firm was offering. So, super important. It also drives the timeline of the VCs, because basically they have all the time in the world until you give them a reason not to have all the time in the world. So I think those are those are some of the most important things. One more thing is raise it before you need it. So, and this goes back to the full-time job of the CEO to do fundraising. You need to, I like to build the relationship so people at least know who I am before I come back to them to raise money. And, that can be very informal. It could be meetings over a coffee or things like that, where there's just some kind of update process where you're telling them about your, how things are going and so on. So when you come back and you're ready to raise money, it's not a super surprise to anybody and you're not starting from scratch.
These are very valuable insights. And you also talk about this in your book, that is
Yeah.
Pitching Falls. The book basically addresses the most common founder errors in fundraising. What are the top?
Yes.
Yeah. Yeah.
Yeah. No, go ahead, please.
Yeah. What are the top 3 technical or behavioral mistakes that you see a founder committing repeatedly?
Yeah. So number one, and this is probably the killer of the three, is targeting the wrong investors. And we did this. I'm personally guilty of it, mea culpa. But we talked to something like 72 venture firms up and down Sand Hill Road. Back in the early 2000s when I was raising an A round. And it's so important, finally, we were kind of wandering in the desert. And then a couple of years in, we were living off of fumes. We were selling some, we were customers, we were getting some cash flow, and we were being funded by our angel investors to some extent. So we kept the company alive. But, finally, we, we had a really good mentor and we talked to him about targeting the right VCs. And he said, you guys are like all over the map. Remember he said to me, find the 20 smartest people in Silicon Valley, smartest in the sense they know the space, right? So they know the space that you're operating in. Maybe they've invested in a previous generation or they're investors in something adjacent to what you're doing, and talk to those guys, right? And so we switched to that strategy, and that was super effective. We got in. One of the 20 became an ambassador for us, and he helped us get funding from Menlo Ventures, who were maybe one of the top 5 firms in the Valley at the time. We also got a term sheet offer from Sequoia, but we got a better offer from another firm. Did not take the offer from Sequoia. So that's the one thing, wrong investors. I had done a guide about that some years ago. I had a free guide that I posted, and then I revisited it because so much has changed. And what we did back then when we pivoted the strategy, you can do it so much faster and so much better today with AI. So I actually went through the process of doing it with AI, and then I wrote a guide about how to target the right investors. So it was the strategy shift, but also how do you do this with AI much more effectively than we were able to do back then. So wrong investors, that's the first one. But the other behavioral thing, which is really common, and I do write about this in the book too, and that's, I call it drinking your own Kool-Aid. So Kool-Aid is this fruity drink. I think it actually used to be called fruit smack. And, drinking your own Kool-Aid basically means, when you put together all this sales material for investors, if you believe too much in your own marketing BS, right, you're not going to register important facts that are happening around you, and you're not going to react appropriately. One of my favorite quotes is from Richard Feynman. He's a very famous Nobel laureate physicist from Caltech in California, Pasadena. And he said, the first principle is that you must not fool yourself, and you are the easiest person to fool. And he was talking about science, but for me, a startup is kind of like a science experiment. There's a lot of similarities. So not drinking your own Kool, but, really keeping your eyes and ears open in an impartial way. Sure, you want to be enthusiastic about your company, but you need to understand the reality you're operating in and what's happening and what's changing and all of that stuff, and be able to adjust. So that's super important. Mistake 3 is losing the investors on the first slide of your deck. And this happens more than you would expect. I mean, it happens really often. And, there's kind of 3 things that people want to know when you're just starting out your pitch. They want to know what you do. And founders often overcomplicate that. So just state it the way you would state it. And if it was the headline of an article in a business journal like the Wall Street Journal, tell them what you do so everybody can understand it. So that's number one. Who do you do it for? Who's your customer? And number three, why does it matter? Right. So this is, you can, a lot of people think the first slide's about, just breaking the ice, but it's really more about making or breaking, because that's where you earn attention for the rest of the pitch. So that's really important. So I'd say that's the third thing. I was once I was helping a company out of Denmark. They were testing the market in the US, and I got them. They were a smart grid company, clean tech company. And so I got them into a meeting with PG&E, that's Pacific Electric. They're the largest power utility in California. And so we're meeting with two technologists from PG&E. And, this CEO was about 15 minutes into his pitch. And these two guys, and they're both technologists in the space, right? One of these guys said, "I'm sorry, I have to interrupt. What is it exactly that you do?" I just remember that moment forever. And it's one of the things that I really harp on when I'm at these. I also have a LinkedIn post out about that. So I think if you put the links out there, there's a guide to finding the right investors, and there's a free guide to the situation around the cover slide. So hopefully that'll be helpful to your followers.
Yes.
Okay. Yeah. So I think those are three mistakes that I see. The first one is like death if you do that one wrong, right? But the other ones are important as well.
Right. And just thinking out aloud is that most of the founders that you see these days, kind of think about an idea, make an MVP, and they start going and start, kind of looking out to raise funds. You have coached hundreds of startups on early sales strategy. What are those measurable signals that a startup has reached repeatable and scalable GTM motion? And how should founder structure their first 10 customer engagements?
Okay. So let me start with what usually goes wrong first. So, a lot of times, especially at the early stage, people think the problem is a sales problem, right? And, often they'll fire one salesperson, and then they'll fire another salesperson, and they'll fire a third salesperson. But the reality is you need to do three things in sequence, right? So the first thing is often referred to as hacking value. And that really means to getting to some kind of problem solution fit or product market fit. And what it really means is, have you found one customer and one solution, and preferably one use case that works, right? And, people will pay for it. They will use it. They will continue to use it, right? So if that hasn't happened, sales is going to fail. And often startups are at more at the hacking value stage, and most sales guys are not great at that. It's really something the founders need to do, but it's something most founders don't like to do because they're usually, engineers or technologists, and it's not their sweet spot, right? But it is something that the founders have to do. Once you hack value, so, okay, we found the right kind of customer, we have a solution, they'll pay for it, they'll use it, they'll continue to use it. Once you have that, okay, now you have the right target. Now you can start thinking about, how do we more systematically, in a more structured way, how do we get to that target, right? How do we identify, engage with, and then turn that target into a happy customer? So that's the hacking sales part at the early stage. And, when does the hacking sales part stop? It stops when you get to a sales funnel. So that's a series of steps to convert a prospect into a happy customer, right? So when you can do that over and over again in a repeatable way,
Yes.
you've basically got a sales playbook or a sales roadmap that works. And then you can get to the third phase, which is scaling that, right? Because, okay, now we've got a sales model that works. We need to do it bigger and faster. We need more money. And then you're you're ready for your next round. So, and I think those three stages, they correspond pretty well to rounds. When you're done hacking value, you can raise a round to hack sales. When you're done hacking sales, you can raise a round to scale. So another analogy I've heard, and this relates to firing the sales guy when you're actually in the process of hacking value, you probably shouldn't even have hired him yet. There's, the story is, yeah, there's a rider, a horse, and a trail, right? And it could be one of those three things. So don't start by firing the rider, right? You need to figure out whether it's the rider, the horse, or the trail. And, that's similar to the, is the problem hacking value, or is the problem getting to your sales roadmap? You need to do things in the right order and then build on the formula that you've achieved for the other part. If you have time for one more story about this was a mistake we made. I was out with one of our board members having lunch. We would often do that in between board meetings, and I would give him an informal update. And we had just closed a few deals with customers. So I was feeling very, very happy and, wanted to tell him about all this. And he was asking, so what's going on the customer front? And I told him, well, we closed Fidelity Investments, and we closed Boeing, and we closed the California State University, and we closed a major accounting firm out of Chicago. And then he looked at me and he said, 1 times 50 is not equal to 50 times 1. And I looked at him like I was one big question mark. And because mathematically, we all know 1 times 50 is exactly equal to 50 times 1. Okay, so what was he talking about?
Yes.
So he said, if you sell to one kind of customer, the same use case, and you do it 50 times, that's not the same thing as selling to 50 different kinds of customers with different use cases, 1 time each. So in the first case, you really start to build industry knowledge. You understand the customer's problem. You understand how they buy, all of this stuff. You really build your knowledge base about your customer. In the second case, you're selling to Boeing, doesn't tell you much about the financial sector, doesn't tell you much about professional services companies, doesn't tell you much about education, which is what we had done, right? So that's the other thing in the early stage. Pick a target. I mean, it almost doesn't matter which one you pick. Companies always want to, well, which is the best one? And I usually say, if you pick one and you focus on it, you'll be better than 95% of the startups at your stage. Of course, you can pivot if something's obviously not working, but that focus is super, super important.
And this is very critical, actually. This is a very interesting one. 50 times 1, 1 times 50.
Yeah. So people are always, so I use that. I use that a lot when I do workshops and stuff. And people are also they're big question marks, just like I was when he said it to me, but it was just extremely useful knowledge or insight.
Jeff, you have helped so many international startups enter the US market.
Yeah.
What those frameworks or validation steps should global founders use before expanding into new geographies?
Yeah. So first, let me talk a little bit broader about soft landing as a whole. And soft landing, consists of a lot of things. It has a legal dimension. It has an accounting dimension. It has a immigration visa dimension. It has an incorporation dimension and so on, right? So all of these things, but also, and most importantly, in the early stage of it, it has a go to market and discover the market dimension, right? Because if you don't figure out where you fit into the US market, which is where I've done the soft landings, the rest of it doesn't matter, right? The rest of it just costs money and it takes time, but it doesn't matter unless you're able to, kind of redo, maybe you've already done the hacking value step we talked about in your home country, but the reality is you have to do it again in the US. So that's one of the first things, we talk to companies about. Even before, I've done projects with them. We've talked about it, when we just initially engage and are validating the market or how to validate the market. So that's super important. And, since the other things cost money and time, we encourage them, put that off. Let's figure out where you fit in. And, if we think about a lot of, let's say you're a health tech company in Europe, right? The European health tech ecosystem is so different from the healthcare ecosystem in the US.
Right.
So, where do you fit into? Do you fit in, and where do you fit in to a completely different ecosystem, right? Let's take financial. Maybe you're doing something that's required by maybe you're providing a solution that helps satisfy a need to be compliant across the EU.
Yes.
How much different is it to satisfy that need in the US, where the regulations are much different, and also where the competitors are going to be much different, right? So you kind of have to redo the hacking value stuff. And that's what that's what we've done in these market fit projects that I've done. I've done them in Manatech. I did them before that in the Bay Area for around 9 years. But, we basically do the market validation. And the way we do that is, we create some hypotheses about going to market in the US, and we talk to some industry experts. And those hypotheses, that's our fundamental thesis that we need to validate. Then we, as part of that thesis, we have an ideal customer profile, and we engage with people like that in the US market, and we test the ideas on them. So, some of the important things that we want to test in that initial market fit validation, things like, one, do they have the problem that you're solving? Two, how high is it ranked? Because companies have lots of problems, right? But if it's not like in the top 2 or 3, it's probably going to be neglected, and there's probably not going to be budget for it. So that's really important. We always want to know, what are you using now, right? Because in most cases, you're not competing against the other guys like you, the other new entrants, the other startups. You're usually competing against the status quo.
Yes.
And the status quo can be an incumbent solution, but it can also be a hodgepodge of things. Like I was working with a company with logistics industry, a startup, logistics tech, and, the industry they were targeting, they were using the phone, fax, email in order to broker between the shipper on one hand and the trucker on the other hand. So they were using all this old-fashioned stuff. They didn't even have a software solution for this as such. So that's what they were competing against. Another example from my own company, TouchWave, we started out with computer telephony, and then we quickly found out that IP telephony was going to be the thing that happened. And so there were 2 other companies, early voice over IP startups at the same time as us. But if you look at the market, everybody was using traditional PBXs from companies like Ericsson and Avaya and Nokia and people like that. That was the actual competition, not these 2 other startups. And what ended up happening is we got acquired by Ericsson. One of the other guys got acquired by Cisco. And then the third company got acquired by 3Com, which is now HP, right? So we all got acquired by bigger companies that wanted to disrupt the PBX providers, and that's why they needed us. But they were not the competition. Maybe the competition to get acquired, but not the competition to get customers. Okay. Yeah. So that was, that's the main thing around soft landing, I would say. And, so during that process, we'll talk to maybe, 15 potential customers, industry experts, and other people to test our ideas. And then if that's successful, then they'll start some sales sprints, which are basically sales experiments. But to do the market fit, often we can even do it with the companies not here. We'll do it through web conferences and things like that. And, we've been able to accelerate it because we have a network here, and most new companies entering the market don't. It's not something you can't do if you're a smart founder. It was just something that we were able to help them do a lot faster. And, one final thing I'd emphasize around market fit, you've got to get yourself out of the sales mindset. You're interviewing people to learn about the market. So you're not presenting a sales pitch to them. You're trying to create a very interactive discussion or facilitate a very interactive discussion where they talk a lot more than you do. So it's to learn some of those things that we just talked about. That's why you're talking to them. So you need to like completely rejigger your brain out of sales mode into more of an exploration mode.
I think that is where most of these founders commit a mistake, because they want to create a playbook
Yeah.
without kind of, you told, cracking the value.
Yeah. Right. So, you need to figure out what they're doing. If there's an opportunity, what solutions do they have? How much do they like it? What would they change? You're trying to see, is there some hole I can crawl through there?
This is very practical, Jeff. You are awesome. This is very practical.
Yeah. Well, I've done all this crap. So,
Exactly. Right.
and I did a lot of it wrong first before I did it right. So,
It's- Now, Jeff, we see AI is kind of reshaping every industry. So how are investors recalibrating their evaluation models, and what specific data points, traction metrics, or team capabilities now matter more for the VCs?
So I haven't been, so let me, let me be frank. I haven't been really on the inside of this. What I have experienced secondhand is there are new metrics that people are looking at. It doesn't mean they're not looking at the old metrics, right? Because it started off with this. I think you could use the phrase that I think it was Alan Greenspan, the head of the Fed,
Yes.
a couple decades ago. He talked about irrational exuberance, and people were just over enthusiastic at that time. And he called that out, calling it irrational exuberance. And there was some of that around in the early stages, 2023, 2024. I think investors have become a lot more critical since then. They're looking at, is this a commodity or going to become a commodity? Is this AI initiative, or is it going to become a feature and some bigger provider, like Google or OpenAI or somebody like that platform, right? So they're looking for some competitive moats. That's what protects the fortress. It's the water around the fortress, right? So they're looking for some competitive moats. And, one competitive moat is the data moat, right? Because, how are you going to keep competition out? So the question here would be, is this company increasing? Is it growing its proprietary data over time, which will help it keep other competitors out? Or is it just like an LLM, which is really a commodity today, right? Because they have pretty much access to the same data. Inference machines are not all that different. So they're looking for something that's, much more proprietary. As an example of something where you grow your data over time, this is not even an AI company, but I think is a good example of how the value of the company increases with data. You could take something like Ancestry DNA, right? Where their DNA matching becomes better, and their matching of your, personal, ethnic, or national origin, it becomes better and better the more customers they get. So I've even seen that, myself. They refine the regions in Europe that my family came from and all this stuff because they get more people in those countries and they have more to match against. So that's an example of a data moat, which takes time to build up, but every time they get a new customer, their data moat becomes better. So this is a key thing for AI companies as well. Related to data moat is, how fast does it get smarter? And that's why when I'm advising companies, also AI, especially AI companies, I advise them to, focus on a microcosm, focus on a niche, because the way to build a data moat and a knowledge moat in a niche is much faster than building it into some kind of very wide market. As a startup, you've got limited resources, limited time, limited money, limited people. And if you focus on a niche, you can become super successful in the niche, and then you can do adjacent markets, or bowling pins, as they're sometimes referred to. So that's a good way to jumpstart getting to this competitive AI mode. So they're also measuring, they still measure things like daily active users and monthly recurring revenue, but they're also measuring daily interactive users. So in other words, how fast is your system learning? Because AI systems they learn through interaction. Of course, they're pre-trained, but then they can, hopefully continue to learn through interaction with actual users, right? So things like that become an important metric as well. But, the main thing is to encapsulate it. They're looking for companies who are not just a rewrap of something else. So you're not just front ending some LLM or something like that. You've got to be building your own proprietary data and inferencing system, through your interaction with your users. The other stuff is commodity. It can be easily replaced by somebody else, or the platform that you're front ending can just get rid of you and front end it themselves at some point if that's what they want to do. Yeah. So and the unit economics is uh, you know basically about seeing your inference cost or the cost of a query, right? Because if you're losing 10 cents, 10 cents a query today, the old joke was, we're losing 10 cents a unit, but we're making it up on volume, right? They need to see a path they need to see a path or a metric that shows that your cost of query is going down over time, right? So that will become profitable.
And Jeff, you have mentored so many startups, through both booms as well as downturns. What is that mindset, which kind of separates founders who thrive from those who stall?
Yeah. I'd say the first thing is the ability to adjust quickly. You have to be, you have to be alert, you have to be vigilant, and you have to be, capable of rethinking things and adjusting. This is not, pivoting is a word that has been, so overused. Every startup, I think one of the biggest insights about startups is that every startup is really a science experiment involving a business, right? And, you have to be, understand that you're in an exploration process. And a startup is basically in a race to find a business model that works before they run out of money.
Yes.
So that's why you need to be super aware and super vigilant. One of my favorite stories is there's an old story about Intel back in the days when they were in the memory chip business, and Asia was completely eating their lunch, especially Japan was completely eating their lunch in the memory chip business. They also had a small presence back then in the processing business, but most of their business was microprocessor business, but most of their business was memory chip. And as Andy Grove told the story, he goes into a meeting with Gordon Moore, and they're talking about the strategic situation. And Andy Grove says to Gordon Moore, if the board fired us and a new executive team walked into this room,
Yes.
what would they do? And Gordon Moore responded almost immediately, they'd get out of memory chips and they'd focus on microprocessors. And then Andy Grove says to Gordon Moore, why don't we do that? So that's just an example of the vigilance and the willing to look at things, look at reality, face reality, and adjust accordingly. So it's not necessarily about changing to a completely different business like pivoting sometimes talks about, but it's adjusting something in the business model. In this case, they're adjusting their focus from a product which has become commoditized to a process where they have a chance to dominate. So I think that's super important. Resilience is important because there's a lot of toilets to clean out there. Things are going to go wrong, and that's the only way you get to things going right is to go through a lot of things going wrong. So resilience is super important. Are you, and especially your co-founders, are you in there for the long haul? Right. There's the old joke about, when the chicken is involved, but when it comes to bacon, the pig is committed. So, are you and your founders in there for the long haul? And, or if people have like other jobs and things like that, that's an immediate super red flag for investors. Yeah. So I think those are some of the most important things. We also we made an adjustment, started, the company that we moved from Denmark to Palo Alto. We started off with computer telephony, which was really controlling your telephone from your computer, right? And we very quickly discovered the world was moving towards IP telephony, which is voice over IP networks, right? So that was an adjustment that we made in our strategy, which, that was really the enabler for us to be able to get acquired by Ericsson after only 2.5 years and 7 times the invested capital. That was absolutely crucial adjustment that we made because we had our eyes and ears open.
I think this was great, Jeff. I think this was very insightful. And would you like to talk something around? There are is it is it required for every startup to raise funds?
It's required for every fast growth, high impact startup. It's not required for every startup. In fact, I've heard raising venture money, I've heard it described by some founders as strapping a time bomb on your back, right? And there's some truth to that. Once you take, especially venture money more than angel money, but once you take venture money, you're on their timeline, not your timeline anymore. And, that's because they have a lifetime of a fund, and they have a business model that's based on portfolio management, right? And it's also based on an extreme power law. So if they have a portfolio of, 15, 20 companies, one, maybe two companies in that portfolio are going to provide the entire return on investment for that venture fund. So accordingly, they want to figure out which those one or two are and then sprinkle a lot more cash on those guys. They don't want to work on the 13 or 12 or however many the others there are who are either going to break even, maybe go out of business, but not provide the return on investment for the fund. So so in that sense, you are strapping a time bomb on your back. You're on somebody else's timeline. You're not on your own timeline, right? So that's really important to understand. The other thing is you can build a great business. It's a hell of a lot easier to become a $20 million company than a $1 billion company, right? So, you're fighting much, much greater odds, but to become a venture fundable company, you need the potential to become the one company that provides the whole return on investment on their portfolio. So even though they invest in 15 and only maybe one is going to do that at best, all 15 are going to have to meet the requirement that you need to be able to become that one company that could provide the return on investment for the whole portfolio, the whole fund, right? So in that sense, if your goal is to provide to build a nice business, even a very, very nice business, that's doing tens of $millions a year, you can do that without venture funding, right? You can do it at your own pace and it's sustainable. You can stay in it or you can, exit from it as you want, but it's not something that you need or even can get venture funding for. Because if your ambition isn't to create that $1 billion company or at least get to something like $100 million in revenue within 5 years of the Series A, then you're not a candidate for venture funding and it wouldn't be a good thing for you. So it really ties back to what the ambitions and intentions of the founders are.
Thank you so much, Jeff, for this super, super insightful session. It's going to help a lot of founders out there across the globe who are building in this space.
My
And
pleasure.
who better than you? Who better than you, Jeff, who have been on all the sides of the table? This is one of the most fabulous sessions that we have done with somebody who has been into execution, who has been on the funding side of the things, has been an investor, and plus he has also helped startups scale in various geographies. Hats off to you, Jeff. Thank you so much for sharing your insights with us.
You're so welcome. Yeah. Thank you very much. Bye now.